before you jump into managed accounts, consider the cost. Typically, 2% to 3% of your assets per year. That sounds like pocket change in a year you earn 20%, but it's up to 1/3 of your stock profits in an average year, and 2/3 of the average profits in bonds. You are simply giving your money away. It's one of the great marketing gimmicks, says Eli Neusner of Cerulli Associates, a Boston-based consulting firm. Jane Bryant Quinn, WashingtonPost.com, May 19, 1996. It probably is a dime. Since the late 1990s, brokerage firms have become very successful in convincing hyperactive investors to pay an annual management fee, a so-called wrap fee, instead of a commission on fund or stock purchases. These firms frequently charge 2% or even 3% of the portfolio's value as a wrap fee. The wrap account first appeared in the mid-1990s in an effort by brokerage firms to minimize the appearance of conflicts caused by commission-based selling. A wrap account is a managed account, usually managed by selected outside fund managers. Investors are told this is a good deal because they are not being charged commissions and they get access to fund managers otherwise available only to very large investors. They aren't told that these fund managers have no more ability to pick stocks or to time the markets than a financial astrologer or a hyperactive broker or advisor acting on his or her own. In reality, wrap accounts are a way for brokers to generate significant fees for doing very little work. The brokerage firm typically pays 1% of the investor's assets to the manager or managers and gets to keep 1 or 1.5% of the investor's assets, splitting between the firm and the individual broker. The investor essentially pays 2 to 3% of his or her assets for the privilege of investing with a manager who has no better chance of beating market returns than mutual fund managers who charge a significantly lower fee. And you have seen how unlikely it is that even these managers can beat the markets. It really doesn't matter if you invest in a mutual fund or a wrap account. If either or both are hyperactively managed, they are poor choices. The bottom line is that the combination of higher costs, lower performance, and greater tax consequences make all investments touted as being able to beat the markets worse than a zero-sum game, which is why smart investors avoid them. Brokers understand fees, but not risk. Odds are, you don't know what the odds are. Gary Belsky and Thomas Gilovich, co-authors of Why Smart People Make Big Money Mistakes. Cost is one of the two major differences between smart investors and hyperactive investors. The other major issue is the relationship between risk and portfolio return. There's a way to mathematically measure how risky an investment or a portfolio really is. It is called standard deviation. It's been accepted as the most appropriate way to measure the risk in investment portfolios since the work of Harry Markowitz in the late 1950s. Markowitz won the Nobel Prize in Economics for his research those hyperactive brokers and advisors either ignore or don't know about. I look at standard deviation in investing the way I look at the results of my blood tests. I don't really need to understand how the lab arrived at the numbers, but I do need to know what is within normal range. In investing, the higher the standard deviation, the more risky the portfolio. Here are some general guidelines using the fall 2005 standard deviation of the S&P 500 as a guide. Conservative investors should have a standard deviation no higher than 8%. Moderately aggressive investors should have a standard deviation no higher than 15%. Very aggressive investors should have a standard deviation no higher than 20%. No one should have a standard deviation higher than 30%, if that. For most investors, that is all you need to know about standard deviation. And that is more than most hyperactive brokers and advisors know. Go ahead, ask your broker what the standard deviation of your portfolio is. If he or she can compute it for you, right there in the office without asking for help, I'll be stunned. In any event, if the percentage exceeds these guidelines, smart investors should get concerned. Too many stocks, too few bonds. Investment policy, asset allocation, is the foundation upon which portfolios should be constructed and managed. Charles D. Ellis, author of Investment Policy. Another important factor in proper investing, after taking account of costs and understanding risk, is asset allocation. Asset allocation refers to the percentage of an investment portfolio held in each of the major asset classes: stocks, bonds, and cash. Many academic studies have shown that the vast majority of a portfolio's variability in returns is accounted for by asset allocation. Very little is accounted for by either market timing or by picking the right security within an asset class. Therefore, it's curious that all the hype you hear from hyperactive brokers and advisors relates to market timing and stock picking. When is the last time your hyperactive broker called you for the sole purpose of discussing your asset allocation? Most hyperactive investors have portfolios that are underweighted in bonds and overweighted in stocks. They are invested in this manner because their advisors have told them that stocks will outperform bonds in the long term. Younger investors are told that they should hold a higher percentage of stocks in their portfolios because they have more time to deal with the bad years, and over time, stocks will outperform bonds. This is basically true. The annualized return of the S&P 500 since 1926 has been 10.4%. During the same time period, the annualized return of long-term government bonds has been 5.4%. These averages are before taking into account inflation and taxes. However, there are long periods of time when this does not hold true. Historically, annualized returns between 1965 and 1984 show that bonds returned approximately 8.05%, while stocks returned approximately 7.8%. In addition, there is compelling evidence that investment risk does not always decline over time. Therefore, it is by no means always true that younger investors should hold most of their portfolio in stocks. Bonds are an important part of your portfolio for reasons other than their performance relative to stocks. The performance of bonds does not correlate highly with the performance of stocks. This means that bond prices do not move in tandem with stock prices. This is perfectly logical. The psychology of investing, often at the urging of hyperactive brokers and advisors, leads people to move money out of bonds when the stock market is rising and into bonds when the stock market is sinking. When the price of one asset gets low enough, there will be buyers who perceive it as undervalued, and when the price gets high enough, there will be sellers who perceive it as overvalued. When you have two asset classes in your portfolio that do not correlate highly with each other, you minimize your risk significantly. A clear import of this data is that bonds should be part of almost every portfolio in varying percentages. You'll learn how to determine the correct percentage for your portfolio in Chapter 37. Typically, hyperactive brokers and advisors ignore this truth. They do so because bonds are not as sexy as stocks. There is not as much opportunity for a steep rise in price. But it is because of this more steady, less volatile performance over time that bonds should be used as ballast in every portfolio to keep it on an even keel. Smart investors understand that an appropriate allocation of bonds in their portfolios is critical to risk management. Risk and reward. The only way to beat an index is to invest in something other than the index. Why would you, when the only source of long-term risk and return data is the index? Mark Hebner, founder, Index Fund Advisors, Inc. Everyone wants to make as big a return as he or she can, but at what risk? The possibility of gaining a few percentage points on the upside may be dwarfed by the increase in downside risk. If you invested in a diversified portfolio consisting of 100% stocks during the period 1973 to 2004, your average return would have been 11.19%. Your worst loss in any one calendar year would have been 20.15%. However, if you had a diversified portfolio invested in only 60% stocks and 40% bonds, your average return would have been 10.49%, only 0.7% less than the 100% stock portfolio. However, your worst loss in any one year is instead of being 20.15% with a 100% stock portfolio, would only have been 9.15%. By moving from a portfolio that is 100% invested in stocks to one that is 60% invested in stocks and 40% invested in government bonds, it is possible to greatly reduce the downside risk while sacrificing only a modest amount of upside potential. Is it worth it to you to squeeze an extra 0.7% on the upside if that means accepting the possibility of losing an additional 11% on the downside? Now, there is a classic objection put forward by those who are invested 100% in stocks, or those who suggest that their clients invest 100% in stocks. That argument has to do with the long term versus the short term. It is true that over the long term, stocks have a better return than bonds. Therefore, they argue anyone investing for the long term should be better off investing completely in stocks. There are, however, two problems with this argument. The first has to do with timing. You never know when stocks will have a run of 1, 2, 3, or even more consecutive down years. If those happen to be the years an investor needs to cash out of a major portion of his or her investments, or if the investor simply does not have the stomach to tolerate those losses, then the investor may be forced to sell at the worst possible time. The second has to do with the basic fallacy of hyperactive investing. Hyperactive brokers and advisors often tell their clients to sell stocks or mutual funds that are on the way down and invest in stocks or funds that are on the way up. But in a market that is generally moving down, even the stocks or funds that are moving up may not move up enough to counter the losses in the previous investments, or may not move up for very long. I will say that some smart investors, those who are investing in funds that match the broadest stock market indexes, and who can commit without reservation to holding those funds for the long term, can safely hold a fairly large percentage of their portfolio in stocks. But I still don't believe anyone should be invested 100% in stocks. Hyperactive brokers and advisors typically do not present data in this manner, nor do they ask these kinds of questions. Their focus is exclusively on the upside, timing the market, picking stocks, and finding hot fund managers who all speak to the upside. Marketing is all about the upside. Smart investors never lose sight of the downside risks. 23. Beware of B and C shares. There is almost no justification for selling B shares in large blocks. Douglas Schultz, co-author of Brokerage Fraud. Most mutual funds sold by hyperactive brokers and advisors have different classes of shares, A, B, or C shares. The reason for these different share classes is that mutual fund families have tried to figure out creative ways for investors to pay commissions and compensate these hyperactive brokers and advisors. Class A shares have a front-end load, meaning the investor pays a percentage commission when he or she buys the shares. Most important, this front-end load percentage declines significantly, as does the broker's compensation, as the investor's level of investment in the fund shares increases. Class B shares levy a sales commission at the time of sale, a back-end load. This commission declines the longer the shares are held. Both B and C shares carry a large annual marketing fee, part of the expense ratio. For many investors, the reductions in A share front-end loads make that the preferred share class. However, hyperactive brokers and advisors have all kinds of convoluted reasons why investors should own B or C shares. For instance, they tell investors that B and C shares have no commission. If pressed, they say that yes, B shares have a contingent deferred sales charge, but that this is less than the upfront load. The real reason why brokers recommend B shares as large initial investments is that they get the highest initial commission for selling B shares. This commission is then offset by the brokerage firm keeping more of the annual marketing fee during the first few years instead of sharing it with the individual broker. After the deferred sales charge expires, B shares usually convert to A shares with their lower annual marketing fee. For most investors, except those who make a smaller investment, less than $50,000, and expect to hold the mutual fund shares for a short time, 5 years or less, B shares are a more costly investment option than either A or C shares. For small, short-term investments, C shares are the best option. For investors who intend to hold their shares for the long term, which is the way mutual fund shares should be held, owning C shares is the most costly option. For long-term investors who have more than $50,000 to invest, A shares are the least costly. While there is an upfront fee, over time the lower annual marketing fee more than offsets the upfront cost, and on investments of more than $50,000, the upfront load is reduced, generally going to zero on investments of over $1 million. But some hyperactive brokers and advisors steer long-term investors to C shares because the longer these shares are held, the greater their commission will be. This is known in the trade as annuitizing an account because the brokers and advisors use this technique to, in effect, create annuities for themselves. The large annual marketing fee keeps coming in every year. Ka-ching, ka-ching, ka-ching. All of this really begs the central question: why are you buying any class of hyperactive mutual fund shares in the first place? And why would you rely on your hyperactive broker or advisor to select funds that will outperform the market? Funds used by smart investors do not have A, B, and C classes, so this is not an issue. That's another reason why you should be a smart investor. However, if you insist on using a hyperactive broker or advisor, and that investment professional tells you to buy B or C shares, at least you now have the information to determine whether or not this is just another way to live you are. 24. Beware of house funds. I find it very disturbing that Morgan Stanley's culture puts sales contests ahead of customers. This is the kind of sales culture you'd expect at a used car lot, not from your stockbroker, to whom you've entrusted your money. William Francis Galvin, Secretary of the Commonwealth of Massachusetts, August 11, 2003, commenting on a complaint filed against Morgan Stanley for sales practices concerning Morgan Stanley-owned and affiliated mutual funds, for which brokers allegedly received higher commissions than on other funds. House funds are hyperactively managed funds created, owned, and managed by brokerage firms. They can only be sold by brokers who work for that firm. They usually bear the name of the brokerage firm that sponsors them, such as the Smith Barney Aggressive Growth Fund. There is no evidence that house funds are a good investment. One study compared the performance of the house funds of American Express, Smith Barney, Prudential, Merrill Lynch, and Morgan Stanley for a 10-year period with similar funds managed by well-known independent fund families. The house funds got trounced. Brokers typically earn a larger commission for selling these funds. It's not surprising that they recommend them to their clients. There is no reason to buy a house fund. This dismal performance record raises a much bigger issue. If the big brokerage firms cannot manage their own funds more successfully, why should you rely on them for advice? The answer is that you shouldn't, and for that matter, you shouldn't buy any hyperactively managed fund. Advisors to smart investors do not work for companies that own, manage, or operate their own hyperactive funds, because they don't work for companies with proprietary funds. They have no perverse incentives to recommend funds that, when objectively viewed, underperform. Smart investors never buy house funds or any hyperactively managed funds. Neither should you. 25. Beware of margin. People want to maximize their return, so they borrow to buy. It can work as long as the market doesn't go down. The smart money sells to the stupid money, and the stupid money usually borrows to buy. Charles Biderman, trimtab.com, a market research company. Reported at southcoasttoday.com. Warning: margin may be disastrous to your financial health. When using margin, an investor puts up the shares he or she owns as collateral against a cash loan that permits the purchase of additional securities. Margin increases risk. Since most hyperactive brokers and advisors don't know how to measure risk, investors who buy on margin are rarely aware of the effect margin has on risk. Margin magnifies risk dramatically by allowing an investor to purchase more of a security than he or she has cash to back up the purchase. If the value of the security drops, the ratio of collateral to loan is reduced, and the investor must either come up with more cash or sell some of the security in order to reduce the amount of the loan and bring the ratio back into balance. Of course, margin is great for the brokerage firm, which charges interest on the margin loan. This may or may not be shared with the broker in the form of a bonus or some sort of soft money credit, such as an increase in the amount the broker can charge to the firm for individual marketing expenses. For the firm, there is no risk in margin. It is a pure profit center. Smart investors never buy on margin. They have no reason to do so. Beware of hedge funds. It's amateur hour in the hedge fund business. This sideshow of sometimes bizarre and always costly investing is on a tear like never before. It's attracting some of the shrewdest and sharpest minds on Wall Street, and also shills, shysters, charlatans, and neophytes too crooked or too stupid to make any money for you. Forbes, the sleaziest show on earth, May 24th, 2004. The hot investment of the 21st century is the hedge fund. You need only be concerned about hedge funds if you have a large net worth, because they cannot be sold to investors who don't meet certain minimum net worth requirements. And many hedge funds voluntarily require a minimum investment of $1 million. Hyperactive investors have poured more than $1 trillion into approximately 8,000 hedge funds. Much of the activity is generated by hyperactive brokers and advisors. They sometimes recommend investments in hedge funds to clients for whom such an investment is completely inappropriate. This frenzy is driven by, you guessed it, fees. Hedge funds typically charge 20% of profits plus 1 to 2% of assets managed. This is a previously unheard of fee structure. Brokers and advisors receive significant fees for recommending hedge funds to their clients. The original hedge funds were pools involving few investors, usually fewer than 50, who each put up a large minimum investment, $500,000 or even $1 million required. Hedge fund managers got the Securities and Exchange Commission to let them run these pools essentially unregulated by arguing that someone with that much money to invest is by definition a sophisticated investor, and therefore hedge funds should be able to avoid all of the regulatory requirements that govern regular mutual funds and brokerage firms. Many hedge funds specialize in making large investments in a few positions, which sets up the possibility for either outsized returns or outsized losses. Others have used so-called market-neutral strategy, which hedges these big bets with counterweight investments, hence the term hedge fund. All you need to know about why you should not invest in hedge funds is found in an article in the May 24th, 2004 issue of Forbes magazine entitled The Sleaziest Show on Earth. For starters, the performance of these funds is often overstated. In the summer of 2005, a hedge fund called Bayou imploded, costing its investors over $300 million. It turns out the fund never earned the gains it claimed it did, and covered up its losses by creating a fictitious accounting firm to audit its annual results. Hedge funds are illiquid. You generally must leave your full investment in the fund for a predetermined period of time before it can be redeemed. You hear about the winners, but not the losers. The cozy relationship between some funds and some major brokerage firms is troublesome. Hedge funds have an extremely short lifespan, averaging less than 3.5 years, thereby depriving investors of the ability to analyze long-term returns. And there is no way investors can predict which of the 8,000 or so hedge funds might outperform a broad U.S. market index in the future. Most investors should not invest in a hedge fund. For those who do, the investment should be limited to a very small percentage of their portfolio. Hyperactive brokers and advisors love them. The commissions are great.